Hi there, my name is Christina Mackay, and in this video I just want to briefly touch on preparing for investor meetings. So in terms of what you need prior to those investor meetings, you need your business plan, you need your pitch deck, and you need your financials. Those are probably the three most key documentations. Make sure they're detailed, make sure you've backed up any assumptions, make sure you've shown your thought process, and you've provided as much evidence as possible. So whether that's feedback from the customer, whether that's data, if you've done a soft launch of your product, or you've tested it with your initial customers, as many metrics as you can is really valuable in there. So those are what you need before you go into meet the investors. And then in terms of when you do meet the investors, really it's all about prepare. So preparing your pitch, researching who the investors are, what they're interested in, if you can find out even what type of personality they have in terms of are they interested in the analytics. If so, make sure you're providing them facts and figures and statistics. Are they interested in the big picture, the vision, the problem you're solving? Make sure you make that really clear. Just really understand and be able to direct different pieces of information to each of those. So that's your preparation. And I do some coaching on pitching to investors. So if you are interested, please just message me, comment below, or message me on in.global. In terms of as that relationship continues with the investors, if they are interested, what they'll start to look for are term sheets. Now, term sheets is an overview of essentially the relationship you're going to have with these investors. So what you're agreeing to. So this will be how much equity they're taking, it will be the type of milestones they expect you to achieve in this time, the team structure of your business, what that will look like. So it's really just summarising what you're agreeing to with the investors. I say summarising, it will be detailed. But the term sheets itself is not the legally binding document. In addition to that, you have the shareholders agreement, and that's your legally binding document. And once the ink is dry, then that's when you've secured your money and they'll transfer you the money. So those are the documents you need to prepare. All of those are available on INN, so please do use them, and if you have any questions, let me know. So now we've talked about some of the things you need to prepare, but what are the investors actually looking for? Well, I have done a 60-second video on this, so you're welcome to view that. But in summary, it's team, so make sure you've got a strong management team that's got some good experience. Market, a large market and a growth market. Your product, service and technology, so do you have IP? Do you have a unique selling point? Is it disruptive? Your customer really is king, so who are you selling to? What type of person? Make sure it's specific. In this one, or separately, you could include your sort of business model. So how are you planning to make money from this venture? Show me the money. That's what the investors want to see, so make sure you do. And just going on from that is your exit. Again, show me the money. The investors want to see what their return on investment will be, so make that really nice and clear to them. And finally, I just want to talk about power and bargaining power. And the reason I want to touch on this is because sometimes I have entrepreneurs coming to me and saying, I need some seed investment from some high net worth and sophisticated investors, and I need that next week. Well, that just doesn't happen, and to be clear, I don't work with people who say that. There will be a lot of due diligence involved in terms of securing that funding, and that can be quite an intrusive process. They will want to understand everything about you as an individual, about your team members, and about your business. They'll want to know about all your failures, and that's fine, it's not a problem, but you will have to be really open and honest with them. So due diligence can take 3 to 6 months. It doesn't have to, but if you're really prepared, you're early prepared, you have all that documentation, you have been really open and honest, and you've provided full details, then due diligence will take a shorter amount of time. But my point in all of this is that if you wait until you're desperate for money, you're not going to have any bargaining power, and the investors will know that you're desperate. So they might say, okay, I see that you need money, otherwise you're going to have to completely shut down shop tomorrow. So I am going to invest in you, but rather than taking 10% for my 100,000, I'm going to take 60% for my 100,000. And they could do that. And honestly, if you really are at the end of your runway, you're going to have to shut down operations the next day, you would have to take that deal, or you might choose to take that deal, because otherwise your entire business collapses. So I just really want to encourage you to think through funding early. I tell people to think through funding 12 months before you need it, because then you can just start to get to know people, start to get to know investors, start to build relationships with them, start to tell them about the milestones that you've been hitting, start to tell them about the increase in customers and how you're shaping your business around that customer feedback. So that when you actually start to come to the conversations about funding, you've built that relationship, they've got to know you, then you can start due diligence, and you've secured your money well before you've fallen off your runway. So just really think carefully about bargaining positioning and bargaining power, so think early. And the final thing I just want to note on this is, if an investor says to you early on, I'm going to invest in you, so just get rid of all your other investors, don't talk to anybody else, and you think, okay, great, and so you stop talking to anybody else, and then 6 months of due diligence goes by, and you're at the end of your runway, but you think, not a problem, I know I'm getting my money today, and then that investor says, actually, I'm not comfortable with the valuation, I want double my percentage of ownership for my investment. I know that sounds really cutthroat and horrible, but that has happened in this entrepreneurial world. So I think what I'm really advising is that you don't stop talking to investors until you know for absolute sure that you've agreed on the valuation, you've agreed on how much money they're investing and how much equity they get in return for that, and you've agreed on the date when that money will come in, and you've signed a contract to that effect. And up until that point, I think you should keep your options open and continue to talk to investors. And there's no harm in talking to investors on a continual basis, because even if they don't invest in this first round, because somebody did do what they said they'd do and did invest, they might be interested at the next round. So it's still great that you've built the relationship with them. So that's it on preparing for investor meetings. If you'd like any more information, please do let me know. You can comment below or join in n.global. You can private message me or chat with me live. Thanks. Bye.